Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday. It's the 17th of September 2021, and today we want to dig deeper into probably currently, but all in all, in general, very interesting topic when it comes to trading, especially day trading in general, volatility and how to use volatility in terms of an increasing profitability in your day trading over and over again. I will give you some ideas how to, probably based on the current volatility in the market or respectively on today's moves. So I already prepared a chart, which I will go through then in the upcoming minutes here. In terms of my personal DAX trading, by the way, so if I trade the DAX, I have I use an indicator here, which helps me to identify not just the current volatility in the market, but also if my stop I plan to place based on my trades, for example, is too tight, or it's perfectly fine to keep the stop as I have it, but also on what to expect if I now enter the market on the upside, on the downside, given recent volatility in the market. And this is exactly what we want to dig deeper into today. I'll give you some thoughts on this from my end. I hope that you can use it in your trading then in the future. By the way, right now you are probably here in the event itself, so you can ask all your questions in the chat box. If you watch the recording on YouTube, please, if you enjoy what you will see now, leave a thumb up here. If you have any comments, if you have any topics for the future you'd like to cover, you'd like to see us cover here, then please feel free to use the chat box below the video. What else? Thumb up, subscribe to the YouTube channel, set a reminder so that you don't miss any of the videos which we are producing here for you. So let's get started, and let me share my screen here, and then we'll go through today's topic. And oh, by the way, now I just see finally it happened. So 1 second. So this is live. This is beautiful. I just the battery in my mouse just collapse is the wrong word. Just doesn't work anymore. So let's put it that way. Perfect. Now you have a mouse here. You can see it. So before we start, let's here first of all have a look into. Okay, that's interesting. Huh. Oh, that's funny. Okay, for whatever reason. First of all, let's have a look here into the current rebranding taking place at Admirals in this case, and here have a look at Admiral Markets earlier and now Admirals right now. So Admirals is a broker which was established its business already in 2001. Is currently probably one of the most renowned and biggest FX and CFD brokers in the world, offering over 8,000 financial instruments. Has a global presence with offices around the globe, more than 20 offices around the globe. Right now, you will see this in the next slide, there is a new regulatory authority in Jordan, which was just opened or established. And so the thing is that now, after years of establishing itself as a real brand in the world of brokerage, multi-asset brokerage, especially not just FX and CFD trading, but also with the Invest solution in equities trading, physical stocks, but also ETFs and so on and so forth, Admirals decided to rebrand, or Admiral Markets decided to rebrand, and now becoming Admirals, since they plan to offer more than just brokerage solutions here to the broader audience, financial services, for example, offering a credit card. And in this context, now saw rebranding. So Admiral Markets is now Admirals. Still, you can find the website admiralmarkets.com, but you can also find the website by entering admirals.com and then / the respective language you're probably looking for, as probably, for example, in terms of Germany, it's the DE or something like that. So for further information, please check out the website. Here this is what I just mentioned in this context. So one world, one broker. And here the regulatory bodies can be found, in fact. So it's not just FCA regulation, but it's also ASIC in Australia, it's CISIC for the European Union. Then in this context, here in this context, the keyword is Brexit. But also Jordan, for example, with a regulatory entity in this context. So further information can be found on the website. And now we want to dig into today's agenda here. Okay. I hope so. To answer Alex's question, yes, I hope so that they pay me for the presentation. Yeah, but this is usually how it works. So now have a look here. Let's have a look at today's agenda and what is the average true range. This is what we want to introduce here. I want to give you some thoughts on the indicator I use. It's a standard indicator, in fact. So, but one which is of serious or true value for not just my trading, but in general. So, for example, when I prepare my trading, it's not just the DAX, which we will use as an example here to show my thoughts, but in addition to that, if I prepare my equities trading, for example, so as of now I'm preparing today's trading day. Earnings calendar is very thin. Still, we have some stocks in play in this context. So stocks which are hot, Lucid, for example, or Iron Tree. In this case, also Iron Tree. One second, is it Iron Tree? Iron Net. I'm sorry, it's not Iron Tree. Okay, that's IRNT. So in fact, it's a not that spectacular name, but one which was played by the Wall Street bets army, or Reddit army, let's call it. So this is a hot topic in social media right now. And what I usually do is I not just look at the volume which is traded here in the pre-market to identify then hot stocks. But in addition to that, I also like to know what is the current value, value of the ATR, respectively the average true range, so volatility in the stock. So what can I expect? For example, when I trade stocks, I'd like to see average true range of minimum $1 per day, so that the stock moves on average $1 in one or the other direction. And then it's not just that we're looking here at the potential which the stock can move, but also that I use the average true range then to identify potential stop level, respectively where to place my stop in this context, and to have a level I can risk against. So that's also something where the average true range comes into play, something I already give you now as an idea in which direction we are headed here with this presentation. Still, I'd like to introduce this concept to you also graphically, so that you understand that it's really of true value for your trading, and hopefully you can use it in the future for your trading. Then I will dig deeper into how I, as a professional trader, use the ATR in my trading. I'll give you the trading range calculation. So what can I expect the market to move, in fact. So today was very interesting in terms of the DAX. And in addition to that, I'll give you an example from today here in terms of the stop loss calculation. But before we go into the practical part, first of all, we'd like to, or I'd like to give you some thoughts here on how to calculate the average true range. So in fact, it's a concept which is already in use for 40 years, over 40 years. The ATR, the average true range, was initially developed by someone you probably have heard in another context, J. Well Wilder. This is also the guy who also introduced the relative strength index, for example, to you. And what he did was that he was trading the markets, and especially the commodity markets. And he realized that if he focuses on the daily trading range, that this is probably not sufficient for the purpose of measuring the market's volatility. And this is because of the fact that back to these days, when there was a longer, let's call it interruption between the trading days. So you have a closing price, and then the next day the market opens again, but there's no trading taking place in between. That you have, especially if you have a volatile market, which is usually the case in commodity space here, that you have gap-prone markets. And so that being said, Wilder said, okay, I have to overcome this issue here. And what he did was he defined a true trading range for the day, and also adding to some extent the gap which happens then. And what he did, therefore, was that he calculated, first of all, the difference between the current high and low of the day, or depends on which time frame you look at this, but let's look at it from a daily perspective. And then he also calculates the difference between the previous close and the current high. And then he also calculates the difference between the previous close and the current low. So I'll give you in the next slide here an overview of how you can how you can visualize this. And then what he does is that he then calculates the average of this true range of the trading day over several days, and then the ATR, the average true range, here was born, the concept behind this. So let's now show you what I'm talking about here graphically. So first of all, what we do is we have two candles, okay? And in this context, then what we do is we calculate the difference between the current high and the low of the day. So this is, in this case, the S1. And then here, this is the next two candles you can see here. And then what we do is we calculate the difference between the previous close, as you can see here, and the current high of the day, which is here, or high of the next candle. And then the next step, then here, you calculate the difference between the previous close and the current low. And then what you do is you obviously then calculate here the true range over the desired number of periods. So default is, for example, in this context, 14. So if you type in average true range in your MetaTrader, as we will use it, by the way, in the upcoming slides, or respectively, when we go into this from a practical perspective, we will use the average true range of 14. So it's the default I use here. When it comes to equities trading, just to give you another idea on where you can, or how you can calculate the average true range. In my case, I'm using 22 or 23. So most of the time it's 22. And why do I use 22, respectively 23, instead of 14 here, the default? That has to do with the fact that I want to know what is the average true range of the respective stock I'm looking at over the last trading month. So, and since we have one trading month, which consists usually of 22, 23 days, then it makes definitely sense to look at the average true range here from this perspective. And so what we will do right in the next slide here, and I go through, and now I just hope that here the theoretical aspect became clear in the slide before. If not, please feel free to ask any questions. That's also true for those watching the recording. So I make sure that I'll follow the interaction taking place below the video after the recording is uploaded in the YouTube channel here on Admirals, and make sure that I follow the interaction and answer your questions. Sometimes it takes some time. What you could certainly do is connect me somehow. So my YouTube channel is Jens Klatt Trading in this case, so my name and then trading after that. I'm not really sure whether that works that way, but I think you can use an @ or something on YouTube too. So this is definitely true when it comes to Twitter. So I'm not sure whether this is also true. If you want to make sure that I answer nearly immediately, because I get a notification then on my smartphone, try it that way. If not, I will definitely make sure that I can answer your questions once I'm checking out the recording which is uploaded in the YouTube channel from Admirals. So now let's dig right straight into how to use it, how to use this concept of average true range in your trading, and how to let volatility play an important role in this context in your trading in the future. So first of all, I was a little well, it was a difficult way to show this, or to write it down. Forecast the price, that's probably something which could be misunderstood in this context. So the average range is not capable of telling you whether the market will go up or down, but it helps you to define potential trading range. So in fact, it gives you a way of here to show you what trading range in the traded market can be expected based on historical volatility. As you will see in our example, in today's case, the trading range of today was wider than it's used to be in the last 14 trading days on average. So if you follow the price action in the DAX, you've probably seen that there was some a volatile environment in which we found ourselves, very unspectacular trading action. The same is true also for US equities, for example. And today now we saw a flush on the downside to and below 15,600 points. And this is mostly due to the fact that we have a triple witching taking place in the German DAX today, and we bounced quite heavily against 15,800 points, and then dropped nearly 250 points from there. But this is also true when it comes to the trading range, based on the historical environment in which we find ourselves, that you also get an idea. Probably you found yourself when it comes to cognitive dissonances, for example. So like loss aversion, you're having trouble letting winning trades run, cutting losing trade short, for example. There's also another cognitive dissonance we usually refer to as FOMO. It's fear of missing out. It's like you start to chase in case of a rising stock, or you think about, well, I want to short the stock now, or I want to short this and that market, and you just didn't hit the button once the signal was delivered. And then you see the market moving in your direction, and you have fear of missing out the complete move. And then you start to think about, okay, how can I enter the market now? And sometimes you enter the market, see a final flush, and then the market reversing, and in fact finding yourself in a losing position. Then, for example, this is the average range will not help you to overcome this issue. In fact, what you therefore need is clear rules you just follow, but it still gives you an idea of how far the market already moved, and until which point this fear of missing out and still entering the market could be of a positive expectancy in this case. So it could be connected to a positive expected value, meaning being a profitable trading decision you take. So this is one way to use the average to range. So how far can I expect the market to move to calculate my risk reward, in this case, for a trade? And the next thing is that in my case, I then use the stop loss, for example, the average to range to calculate a stop loss that way around. So in this context, what I usually do is I try to identify a level I plan to risk against. So in the DAX example we will use in a few seconds here, we will see that I risk against the daily highs, and then I wonder if my stop is fine there. I mean, in this case, I mean, you could say, well, everything which breaks above or two new daily highs is probably you're definitely on the wrong side. But still, there might be occasions when you say, hey, if I'm risking here against this and that level, but the average range is greater than that, does it really make sense to risk against that level? Because chances of the market flushing you out and you're just a victim of some kind of noise in the market here, and instead of seeing a real move, is increased here if you place your stop too tight in this spot. So this is also a way how to use, in fact, the average to range in your trading. So by the way, when we come to let's probably come back here to forecast the price trading range of the day. I just realized that in case of the stocks I just mentioned here earlier, which I have on my watch list for today, in this case Lucid, for example, we have this is very interesting, in fact. So I have no chart prepared or something like that, but just from a theoretical perspective, if you want to watch this, look this up, then we will, where you can also, when watching the recording, then watching it and remember, okay, it's the 17th of September, he's talking about Lucid, and then check into the chart. And what you will see is that the region around 22 is currently of interest. So, and what I say is, as long as we can hold 22, in case of Lucid, then we have some room on the upside, probably up to something like 23, probably even higher than that. This might especially true since the stock has a quite elevated short float in this context, and could be then a candidate here for another short squeeze, similar play to IRNT, which just happened several days ago, and initiated from the Wall Street bats, Reddit, trading army, however you call these guys. And what's interesting now is if I'm trading against 22, if we can hold this level, then and I say, okay, I'm risking here, and then I say, well, the average true range in the stock is something like $1.30 or so for the last 22 trading days. I say minimum or max risk I'm willing to take is around 20% of the ATR. That means something between 20 to 30 cents risk I'm willing to take. So that's for the upside, but that's also for the downside. And now what I say is, okay, as long as we trade above 22, then I wonder, or I'd like to take the long side. But what happens if we drop 22? Am I then willing to trade the short side? Because I don't think that it's a justified move. We've already pushed quite high, and then also an intraday trend is broken. Probably it makes sense to consider the short side. But, and now the interesting thing comes into play. I say, okay, if the average to range is $1.30 and I'm risking here, let's say 20 to 30 cents, and I see already a potential support coming into play around 21. We dropped 22, so probably I'm getting into a trade around, let's say 21.80 or something. I have 80 cents on the downside, and I'm risking 30 cents, which makes sense in this case, because if I'm entering at 21.80 and I risk against 22 is a crucial level. As long as we trade above, I just said I'd like to favor the long side. So if we recapture 22, then probably I don't want to be short anymore. So definitely makes sense to have a stop that way. But now the thing is, if I'm then going for a move as low as 21 for 80 cents, risking 30 cents, the risk reward is probably not that favorable anymore. So still we have a risk reward of something like 2.5 or something, which is still okay. But in my case, for my trading, I'd like to aim for a risk reward of minimum 1 to 3, if not more than that. That could be then an indication that I say, well, here in this case, you see, I'm working with the average range and around it. And I say, okay, based on what I know, based on historic volatility, probably it's not such a favorable environment. If I take a trade, put it differently and right from a trading perspective, if I take a trade here, then I probably take it with a reduced position size, since the risk reward is not that favorable. And thus I should probably think about this. So that's one way to use the ATR in the current environment, in fact. So now let's have a look here at a practical example. By the way, let me just check if I have any questions here. Okay, yes. Again, any questions, please feel free to ask them right here in the chat box. And by the way, I also have to, just one sec, have to look up something. Probably you're already used to this if this is not the first webinar you're watching here, but I have some key components I have to enter here in my spreadsheet before I enter the trading day. Then for the future, if I write it down, or if I take a trade, then I'm, oh, that's interesting. What just happened? Oh, that's interesting. One sec, please. Okay, that's interesting. If I write it down in my trading journal in this context, then I'd like to have some key stats, which I then use to see whether my trade fit certain criteria, and then take it from there. And that's the reason why I have to now type in here the numbers. It's 1.93 million pre-market volume, which is traded. This case of Lucid, for example, 50 million shares is usually the average volume which is traded. This is data, by the way, you get on Finwiz, for example. And then I'd like to see minimum 1.5 million shares being traded. So 10% of that, in this case, 1.9 million, obviously, is above that threshold. And thus I can say, okay, this is an environment in which I'd like to, or I consider the stock to be hot, and then take a trade from there with a crucial level, technical level around 22. But now let's come back to the presentation. So let's give you first an example, and then use this example and to build from there in our practical example. So let's say that the ATR in the DAX is 250 points on D1. That means on a daily time frame, you look at the last 14 trading days, and then you have an average trading average true range of, or indication 14, or parameter 14 default of 250 points. So this means nothing more than that the average fluctuation of the market, so what a fluctuation range here of the last 14 DAX daily candles averages 250 points. So that means that you might have one with 350, then you have one with 100, and so on and so forth. And what you do is, in fact, you get an average true range here for the last 14 candles of 250 points. And what we now do is we assume that this range will not be significantly exceeded here on the following trading day. Or in other words, what we do is we add, respectively, we deduct here the ATR 14, or in this case, 250 points from the closing price of the day before to get a price limit on the up, respectively on the downside, and thus an extreme for the trading day. That does not necessarily mean that we are not reaching this or overshoot here, but still it's a first orientation on what we can expect to happen here. What is mathematically normal, let's say, put this in quotation marks, for the last trading days. And now what we could say based on our input here, if we assume that, let's say, the DAX opens with a gap up of, let's say, 200 points, we assume that it only has around 50 points more on the upside to run, respectively. What we can assess that way is the potential for a long trade, whether the risk reward in this context is attractive enough for an intraday long trade, for example, if we plan to take a, let's say, open range breakout or something like that. And so let's here have a look now at the DAX. So what you have here is the MT5, and within the MT5, you can now, by the way, you can see here there's DAX 30 and DAX 40. Very interesting, because on Monday, we see an upgrade here from 30 to 40 companies in the DAX. All the information is available on the website. Let me just see if I can find it right here, right now, and then I will share this news here from the website in the chat box. Let me just see. There we go. So there we have it. Here's the chat. Okay, so here's all information on the DAX 30. As you can see, by the way, this is grayed out, DAX 40, while DAX 30 is still tradable. On Monday, the DAX 30 will be grayed out and DAX 40 will be in black, which means then you can trade the DAX 40. There will be no changes to the index reading. It's just based on the market cap. It's a purely mathematical construct. We don't dig too deep into this, but just if you're irritated why we have here in this context DAX 30 and DAX 40. So if I do the following here and I bring this over, you can see there's no change. But then the DAX 40 we look at here, but there's no chance to trade it because it's grayed out. Okay, so this is by the way very, very important here to note, because there's no change to your overall chart layout in this context. So you have the chart on the DAX 30, and then you can just bring in here the DAX 40. And thus, where then the lines will not be affected by that. But let's come now back to our average to range, and what you can already see here. So this is a daily chart, and what we have is we have 185 points. So this is the ATR reading. Let me just, by the way, do it that way, so that we can then go through this here step by step. So we have an ATR 14. I'm sorry, 14 of 185 points. And now we take the Y close. This is yesterday's closing price. So we have today the 17th of September. So we have the 16th of September. And there we have a closing price of 15,694. 15,694. So this is the closing price. And now what we do is for today, based on this information, we calculate the potential on the upside, respectively on the downside for the day, a trading range. So what we take is, I call it just H for high and here the low, and probably we'll do it HT and we will do it LT. And this is just as an indication. It's just an idea on what to expect for the upcoming day. Again, we can overshoot here, as you will see, but still, this is giving you some very interesting ideas on how to use the average range in your trading. And so we have 185. So we use this closing price from yesterday, and then we add those 185 here, respectively. We do the same. We deduct the 185. And now let me do it that way. So 15,694 plus 185. It's 15,897. 15,879. And then we have again 15,694 minus 185, 15,509. 15,509. So what I just did is what I wrote down in the slide. So I took the closing price, yesterday's closing price. I took the ATR of 185, and I just added it here on the closing price and get an idea on how much potential on the upside do we have, respectively, how much potential on the downside do we have. This is nothing more than just from a pure theoretical standpoint, what to expect for the day, but it can help you then find out whether long trade or short trade might be of interest, and based on a risk reward calculation. And this is something what we want to dig into now. We want to use today's trading day. So this is the daily here in this case. And what's of interest for us is in fact what happens here on M5, in my case at least. So you can see here, I also have the ATR then on a 14 minutes time span below that, but this is not what's of interest for us. This is something I'll go through with you now. Let's go back here to the slide. So again, what we just did here is what can we expect to, or how much potential do we give the DAX on the upside, respectively on the downside for the respective trading day. 185 points based on the ATR 14. We take yesterday's closing price, we add it, we deduct it, and take it from there, and then say, okay, well, obviously this is something we can work with. And so in the next step, then we go into how to use the ATR from a trading perspective, from a day trading perspective in this context. And so what we have here now is I have in fact two favorite approaches I'd like to use here. So the first one is what I do is my stop is set based on the ATR or based on volatility in the market, or differently put, since the ATR reflects the so-called normal fluctuation here of the respective markets, I use in fact the ATR as a first indication of how far the stop should be from my trade if I enter a trade. So that means in case of an ATR, let's say of 150 points in the DAX, if I now take a trade based on the first print of the day, so there's in fact a very simple trading approach which has some significant performance. In fact, it's no joke that you can say there's a tendency of the DAX to move in direction of the overall advantage you can identify based on an exponential moving average on a Monday, on a Thursday, and on a Friday, while the other 2 days, so Tuesdays and Wednesdays, are usually so-called, how can I say, corrective days. That's probably a good way to put it. So that means, directly speaking, if we have an daily chart, a daily DAX here in this case, and we take the exponential moving average 40, put it on the chart, and we see a closing price above the EMA 40, a daily closing price above the EMA 40, we take a long trade from the opening print here every Monday, every Thursday, and every Friday, while we take a short trade then on Tuesday and on Wednesday, and the other way around. So it means if we open below the EMA 50, we take a short trade every Monday, we take a short trade on Thursday and Friday, and we take a long trade on Tuesday and Wednesday. And so you enter the trade right on the first print. And so that goes back, as long as I remember, there has been a time once the future DAX was tradable between 8 a.m. till 10 p.m. German time. And now they extended trading hours due to the Asian markets and all that. And that happened already, I think, in 2018, in December, if I'm not mistaken. So there was no overnight trading taking place. But even if you now say, okay, we have this overnight trading, we still take the first print at 8 a.m. in the morning, German time. So this is a 9 a.m. Estonian time in this case. So the server time you see in the MetaTrader when using Admirals MetaTrader here in this case. And MetaTrader first print, yeah, and this is the reason why 8 is because this is the time when the institutional players come into play. So you see Xetra open, spot market opens at 9 a.m. German time, and you have 1 hour before between 8 a.m. till 9 a.m. where the institutional traders are among themselves, let's say. And well, this just the entry logic. Now you might wonder, okay, I keep the trade open the whole day, yes. And where do I place my stop? ATR based. So what you do is you say, okay, based on the recent volatility, I then say, I place my stop this and that % from the entry point away. And that way you can find out that you can formulate a profitable trading approach in this context. And so this is something you can understand here, how you can calculate your stop based on volatility and based on the ATR. And so again, what we can say is then in this context, for example, if we have 100 points stop with or 150 points ATR, we place the stop 150 points away from our entry. You can also work with a multiplier here to say, okay, it's not just 150 points, but probably 2 times the ATR. And then that being said, I take 150 multiplied with 2 then to get my stop width in this context. That's also a way how to use this. And this is one way how you could use, in fact, the ATR. But what we want to do is here is the second way I'd like to present to you today. What I do is I identify the stop based on the price action, the recent price action in the market. And then what I do is I calculate the difference to my entry point here. So might be, let's say entry point is 15,700 and my stop might be 15,725. And then the ATR tells me, hey, average range is just 30 points. So your stop might be too tight in this context because your, let's call it price action based stop is 25 points, while the average range shows you that the, let's call it volatility in the market or the noise in the market is 30 points. So your stop is probably too tight. And this is something then where I say, okay, I can say, okay, my price action stop is greater than the ATR. Okay, great. Then the stop is outside of the market noise and it's perfect. Or as I just illustrated to you here with this example, my price action stop is less than the ATR. Then the stop is within the market noise. And even if it fits perfect from a price action perspective, still you might be a victim of a random stop out here. So you should probably think about widening your stop to a level which makes sure that you are not placing your stop within the current market noise. And so while this might now sound very, very theoretical, let's again go back here to the DAX and not just use here or show you, illustrate you how I calculate my stop, but also remember our first part here and use this then, in fact, to say, okay, how much potential do we have on the downside? But first of all, let's start here. So we start trading day. So this is where it all started today. So that was Xetra open. We see a flush higher, and you see that we have some trouble here around 15,800 points. You can also see this, by the way, when looking here at the. Oh, that's a little unfortunate. Let me just see. You can also see that we had some trouble in this area here the days before. So already that was, by the way, the region around the weekly market highs here. So the high of the range which we saw over the last trading days, and then we see a spike higher, but we fail to capture 15,800 points. That itself alone does not justify a short trade, at least not at my end. But I also use, for example, here the EMA 50 on a 5-minute time frame as a let's call it advantage identifier. That means as long as we trade above that, I consider the overall advantage long. But if we roll over and then drop below the EMA 50, I then think that the overall advantage just switched to the short side, and then I'd probably look for a short engagement. So, and this is exactly what happens then here. Several minutes later, so around 10 a.m. in the morning here, German time. So we initially squeeze higher, fail to break 15,800, drop below this blue line in this case, and then we consolidate above. And what you can see here is that we don't make it back above that level, but we see an attempt, but then we roll over again and drop again. So we have around here 15,000, let's say 720, 700, probably 18, around here, this region, you have probably a short entry. And then you wonder, okay, where do I place my stop? And you might say, okay, I place my stop here above that level, 15,738. The problem with this stop is if we enter at, let's go back here, if we enter at 15,718, I'm sorry, that's the wrong way, that way around. So we have the entry short here at 718, and we then say, hey, we work with a stop of 20 points, 738, that way. We have 20 points stop. The problem is that you can see here that the average range around this time has been around 17 points. So you now might say, hey, this is perfect because 17 points, that's below 20 points, but still you can see that's only a difference of 3 points. And that's one way, or then where I say, okay, probably that's too tight. The stop is too tight, even though it makes sense to some extent. Some might say, well, it makes sense because if we say that the overall advantage is identified by the EMA 50 here on a 5-month time frame, and we make it now above that level, we don't want to be short anymore. That's true, but there have been occasions in the past, and you will see this over and over again, that we see some spikes here, and then we still roll over and drop, but without us, because we got flushed out by a random move here, by a coincidental move in the market. So that being said, it might make sense to say, okay, a stop of 20 points is probably too tight. Thus, I make I do the following: I calculate the ATR, which is around 17 points, and then I multiply it by 2 and work with the stop of 17 multiplied with 2. 34 points, 30 points probably in this context. So I have a stop here 10 points higher than that, and thus work with a 30%, 30 point stop in this context. That's the first thing. Now, remember what we did in the first region here. So, or in the first part, what we did was we calculated the potential on the upside, respectively on the downside, the trading range based on the closing price from the day before. And we said on the downside that we see potential as low as 15,500 points, which obviously gives us a very, very attractive risk reward, nearly 10 to 1 in this context. But still, you probably wonder, does it make sense probably to take out a trade, let's say around this level here, 650 probably, or 640? Sure, it does, and sure, we still get a very favorable risk reward if I go with a target around 640. But still, that probably is not. We have further potential. We have probably further potential here on the downside, even though we might probably consider some kind of profit taking on the way down. But still, I'd like to keep at least part of my initially aided position here down to this, let's call it very aggressive target. So that being said, we could then formulate a plan where we say, okay, we enter the market, let's say with 100% in terms of 4 contracts, let's put it that way. So 4 contracts, we enter the market. And then we say, okay, I take partial profits. Let's say first one is around 640, something like that. I take the first 25% off, or let's say 33% probably. So and in this context, we might say, okay, it's 1.3 contracts we take out. Once we reach the region around 640, the next one is probably around 600, the next round level, 1/3, and then I have still 1/3 left from the beginning of the position, so 1.3 contracts. And here I go for a very aggressive target on the downside. once it's reached, so 15,500 points, I get a big bang for this last part of my position. Well, what we can then certainly see is here, we flush down to 550, consolidate, and then we turn around. So you probably have a reason to take out the position then once we bounce back to 600. So we didn't make it to that level, but still you can see that here you're first of all in your position you just entered, you entered the position based on the stop calculated on the ATR based on the volatility in the market. So it made definitely sense to here look for a stop 30 points higher from your entry point. In addition to that, we also saw that we could easily give the market room for a run below 15,600 points, at least based on a volatility calculation we did earlier here, and where we said, well, based on the closing price and the current ATR, we probably have potential as low as 15,500 points on the downside. We didn't make it to that level, but still, that was a first way to calculate our potential profit on the downside. And then next thing is also possible, and this is where we close the cycle now to the FOMO aspect I mentioned earlier. Let's just assume that you say, hey, I just plan to enter the market here somewhere in this region around 640, because you say, well, I see that we have seen no selling pressure, but I missed the entry point. Wherever you might have missed it, doesn't matter. But now you wonder, does it still make sense to enter the market here in this area? I'd say no, not because I know that the market turned around here, but because if you enter, let's say 640, you plan to enter the market based on whatever reason at 640. Probably you say because we just broke here below yesterday's low, for example, retested it, couldn't make it back above that, and that's the reason why I take the short. Now, let's use now, again, a volatility stop here, the idea behind this. So the volatility stop, as you can see here, should be minimum 25 points, probably double than that, so 50 points, some in between 40 to 50 points. And if you enter now at around, let's say, 620 probably, and place your stop 50 points higher, you're at 670, volatility wise, completely fine to have a stop that way. But now you say, okay, I enter at 620, but how much potential do I give the market based on this idea here, based on the volatility calculation I made initially in regards to the potential on the downside? And then you will see, okay, well, in fact, we probably have potential as low as 15,500 points. You could also say, well, we initially saw a push up here to 15,790. That's also a way to then go here in terms of the average true trading range. It's in fact bringing us then closer to this level where we then, by the way, turned. You could then say, okay, here based on that, probably we have potential down to 15,600 points, probably a little lower than that, but not much more, given the high which we marked here around 780 or 790 in this case. So that being said, if you enter at 620 with a stop of 20, 50 points, 40, 50 points, and you only have max probably 50 points on the downside, well, we saw that we overshot here a little and would have some kind of a move like 70 points in our direction. Still, we do not get a risk reward of greater 2 in this case anymore. That being said, it does make sense to jump here after the trade and chase or sell here then on the downside to hopefully get some meat on the bone, some final meat on the bone, let's call it. But in fact, just probably say, okay, I skipped the trade because it's risk reward wise not attractive anymore to enter here in this area, given what I could calculate based on historical volatility in the market based on the ATR. So yeah, I just hope that that this helps you now from a volatility perspective to get a better idea here, how to calculate your potential profits targets on the downside, but also potential stop levels in the future in your trading. Let's sum everything up here. So first of all, the development of the ATR, this beautiful trading indicator, goes back to J. Wilder, who initially applied the ATR to a commodity trading after realizing that the focus on the daily trading range here wasn't sufficient for the purpose of measuring the market volatility, and therefore he calculated the ATR, the average true range. What he does is he calculates the difference between the current high and low, the difference between the previous close and the current high, and then the difference between the closing price and the current low, and then calculate the average here based on these numbers he just receives over the wished period he'd like to apply. Then professionals use the ATR in the following ways in their trading, at least as far as I use it, let's say, to forecast respectively, to forecast the trading range, to get an idea of how much potential the market has. It doesn't mean that it can't move farther than that, but the thing is that you probably should take it into account, and the more aggressive, or the wider you calculate your price target, and the more it extends the average true trading range, you could calculate, and you get you already have, that this has been the recent volatility. Well, the more unlikely it is that you will probably reach this profit target. So this is definitely something to take into account. And then what we also have, that the stop loss calculation can be based on volatility. So one question from Victor: if I think that this can be applied to currencies, 100%, sure. Definitely. So this is the great thing about the volatility in this case, because every market is different, and every market has another level of volatility in it. So one market might be more aggressive. There's higher levels of volatility. Thus, based on the ATR, you can then say, okay, the higher the volatility, the lower the position size, or the lesser, the less aggressive I should take my position size. Then there might be assets where you have a very low volatility, and thus could build a bigger position, but risk the same amount in absolute terms when it comes to Euro, USD, JPY, whatever currency you have in your account. So this is one aspect why I, in fact, love to use volatility in my trading, respectively, use it as a risk calculation tool here in this case, because it is independent from the market. I mean, the structure in the asset you're trading here in this case, independent from the market, it depends on the market you traded. That's the best way to put it, probably. And thus it means that based on volatility, you get already a good idea whether the market moves stronger on an intraday basis in one or the other direction, or if it's a lower volatile environment. And thus it is perfectly fit. It's not just fitting perfectly when it comes to currency trading, but also commodities, stocks, as I pointed out earlier, indices, crypto in this context, like Bitcoin, for example. So it's a in fact great way to calculate volatility. And oh, that's well, yeah, that's in fact it already. Let me just see. I just lost one here. There we go. I just lost one slide. So next time I'll be here again. That will be on Wednesday, in fact. And what we will do is we will look at NVIDIA after the recent split. You probably have seen it. NVIDIA split its stock price by 4. And now the question is if it's the first or the next 1 trillion market cap company after Microsoft, after Google, after Amazon, after Apple. So NVIDIA is in fact one of my favorite stocks, in fact, also based on their overall business model they have. I will give you an oversight in terms of artificial intelligence and where where NVIDIA stands in the AI space here in this context. And I will also show you, certainly more basic, but still, what a stock split is, why a company takes such a step, and everything around this topic will be discussed here on Wednesday, 22nd of September, 21, 2 p.m. London. Check your inbox for the webinar link if you already registered. If not, head over to admiralmarkets.com and there to the education tab here, webinars tab, and the educations tab, and there you can register for the webinar. I really look forward to the event because it was just a fascinating topic, in fact, and the fascinating company. Further details on Admirals, again, on the website, or check out here the YouTube channel. Set a reminder for every of the upcoming webinars which we'll produce for you. Subscribe to the YouTube channel, and also visit the Facebook presence, Instagram. Also send a mail to the colleagues in Italian here in this case. And this is the risk disclaimer, fully regulated broker. So this is how we will end this presentation. I wish you all the best. Happy trading. Watch your stops. Talk to you again next Wednesday. I really look forward to it. See you there. Bye-bye.